Imagine a family standing inside an unfinished apartment, not because they wanted a view of concrete, but because this empty shell had become the center of their finances. Years of savings had moved into a home that would be completed, a neighborhood that would grow around it, and a future that seemed safer because it had walls, a mortgage, and a place on the city map. To them, the developer was not a distant corporation. It was the bridge between work and security. When that bridge trembles, the shock is not only economic, it enters the nervous system, changes how people speak about money at dinner, and changes how a worker reads the news before sleep. This is why a balance sheet can become more than an accounting document. On paper, it lists assets, liabilities, cash, loans, and obligations. In real life, it is a map of trust. Every number quietly points to someone else's expectation. A bank expects repayment. A supplier expects cash. A construction worker expects wages. A buyer expects keys. A local government expects land revenue. An investor expects growth to continue long enough for risk to remain invisible. When those expectations are chained together, debt stops being private and becomes public structure. Debt is not automatically dangerous. Debt can build factories, homes, roads, and businesses that would otherwise take decades to create. It moves future income into the present, allowing society to accelerate. But acceleration changes the physics of an economy. When borrowing is tied to productive cash flow, debt can be managed with discipline. When borrowing is tied mainly to rising asset prices, the system becomes fragile because repayment depends less on what the asset produces and more on the belief that someone else will value it higher tomorrow. Real estate is powerful because it sits at the meeting point of emotion, credit, politics, and identity. A share of stock can feel abstract, but a home feels personal. It represents safety, adulthood, family status, and belonging. People do not evaluate housing only with spreadsheets. They evaluate it with fear of missing out, fear of falling behind, and fear of disappointing their family. This emotional weight gives property markets a unique ability to absorb national hopes. When prices rise for years, the rise begins to look like proof of progress. When people borrow against that belief, hope becomes collateral. The mathematics of this system is simple, but its consequences are not. A developer buys land, often using borrowed money. It sells apartments before completion, using customer deposits and mortgage proceeds as financing. It borrows from banks, issues bonds, delays payment to suppliers, and starts more projects. As long as sales are strong and prices are rising, cash keeps moving through the machine. New buyers fund construction. New borrowing refinances old borrowing. New land purchases support future growth. The company may appear successful, yet its stability depends on a continuous inflow of money. This is where scale becomes deceptive. A large company can look safer because it has many projects, many customers, many creditors. But scale can also mean that small errors multiply across the system. If a developer has hundreds of unfinished projects, a slowdown in sales does not remain local. It becomes a coordination problem. Every participant asks the same question: will the next payment arrive on time? Once that question spreads, behavior changes before final numbers are known. Buyers hesitate. Banks tighten. Suppliers demand quicker payment. Investors sell. Employees worry. The system conserves cash, reducing the flow it needs to survive. At the psychological level, this is a story about confidence transforming into dependency. In the early stage, people believe in the company because it is growing. In the middle stage, they believe in it because everyone else believes in it. In the late stage, they need to believe in it because too much has been committed. That final stage is dangerous, not because people are irrational, but because incentives have changed. A buyer who has paid for an unfinished apartment may ignore warning signs because acknowledging them feels like accepting loss. A lender may extend credit because forcing default could damage its own books. A local economy may tolerate imbalance because the alternative would reveal its dependence. This is one of the hidden traps in financial systems. What looks like optimism from the outside may actually be trapped capital from the inside. People keep participating, not because the numbers are beautiful, but because stopping would be painful. That pain creates silence. Everyone sees pieces of the problem, but no one wants to be the first to make the problem real. Markets often collapse not when information appears, but when enough people stop pretending. The history of finance repeats this pattern in different costumes. In the American housing crisis, The central belief was that home prices across broad regions would not fall together. In Japan's asset bubble, land values became tied to permanent economic ascent. In railway manias, investors confused useful infrastructure with limitless prices. The details differ, but the structure is familiar. A useful asset becomes a symbol. The symbol attracts credit, raises prices. Rising prices validate the symbol. Then leverage turns a normal correction into a system event. Leverage is the mathematical hinge. Without leverage, a falling asset price hurts the owner. With leverage, a falling asset price can hurt suppliers, employees, customers, and institutions that never thought they were making the same bet. Suppose an asset is worth 100 units and is funded with 30 units of equity and 70 units of debt. If the asset falls by 10%, total value drops to 90, but the debt still demands 70. The owner's equity falls from 30 to 20, a one-third decline. A small move in the asset becomes a larger move in the owner's capital. If the decline continues, pressure accelerates. This is why leveraged systems can seem stable for years and then deteriorate quickly. For ordinary people, the most important lesson is not that all debt is bad or that all property is dangerous. That would be too simple. The deeper lesson is that every financial decision belongs to a system. A mortgage is not only a monthly payment, it is a claim on future income. A house is also exposed to local wages, credit conditions, population flows, interest rates, construction supply, and policy choices. A job connected to a booming sector may be linked to the same cycle that supports the price of the home and the confidence of banks. This overlap creates hidden concentration. A person may think they are diversified because they have a salary, a home, and savings. But if their salary comes from construction, their home value depends on construction demand, and their savings are invested in companies tied to the same boom. They may be more concentrated than they realize. Risk is not always visible as one asset. Sometimes it is hidden in the fact that different parts of life are sensitive to the same economic weather. This is where wealth thresholds matter. Before a person has a cash buffer, the primary financial question is survival. Can this month be paid for without damage? After a buffer exists, the question changes: how many choices remain available when the system becomes unstable? Liquidity is not glamorous, but it gives time. In a debt-driven economy, liquidity functions like oxygen. It does not create wealth by itself, and it does not remove risk, but it can reduce forced decisions. The identity shift is subtle. Many people are taught to see wealth as ownership, owning property, owning investments, owning visible assets. But mature financial thinking also sees wealth as optionality. It asks what an asset is worth today and how dependent that value is on uninterrupted confidence. It asks whether debt remains manageable when income pauses, prices soften, or credit becomes less generous. It asks not only how large a company appears, but how much of its size is supported by obligations that must be rolled over again and again. A debt empire does not usually announce itself as an empire of debt. It presents itself as growth, ambition, modernization, and scale. Many parts of that story may be real. Buildings are built, jobs are created, cities expand, families move into homes. The danger begins when the story grows faster than the cash flows that support it, and when too many people mistake movement for strength. A machine can be moving quickly because it is powerful. The calm conclusion is not cynicism. Economies need credit, housing, infrastructure, and enterprise. The point is to understand the difference between productive borrowing and fragile dependency, between confidence and compulsion, between assets that generate durable value and assets whose value depends on the next buyer arriving in time. When one balance sheet shakes a nation, it is rarely because one company made one mistake. It is because that company became a mirror, reflecting assumptions millions treated as permanent. And so, the unfinished apartment remains the image. It is not only concrete and steel, it is a question suspended in space. How much of our feeling of safety comes from real foundations, and how much comes from a system that must keep moving to preserve the illusion that everything is complete?